As each new year rolls around, financial markets become awash with a series of predictions as to what we might expect in the upcoming year. I mentioned in the blog that I would take a deeper look at predictions, and I want to look at the notion of why people make predictions, and more importantly, why people take notice of predictions, and why they take notice of predictions even in light of the knowledge that most of them are rubbish. But in terms of definitions, a prediction is a statement about something that will happen in the future. It involves this notion of forecasting, foretelling, or estimating an event. There's a little bit of a distinction in this statement, and it gives some light as to the distinction between forecasters and traders. Forecasters assume a very linear, concrete nature to their statement. They assume that it will be correct. Traders estimate events and place bets accordingly. So there is a differential in the interpretation of what we're attempting to do with our estimate of future events. Forecasters believe that their estimations are rock solid, that they are going to occur. Traders have an element of doubt. This is why we never go all in on positions, because doubt is an important part of the trading equation. It is this notion of variant perception, the notion that you might actually be wrong. Forecasters don't have that notion that they might actually be wrong, despite the fact that they consistently are. I'm quite certain that if you looked up Dunning-Kruger in the dictionary, you would probably find pictures of forecasters, because forecasters are the archetypal example of the Dunning-Kruger effect. They do not know how bad they are at something, but they assume enormous confidence at the thing they think they can do. So I often default to this statement by the physicist Niels Bohr, who somewhat sarcastically says, prediction is difficult, especially about the future. And it is. And I will look at some of the reasons as to why forecasting is so difficult within markets. People make these predictions based on the presumption or illusion of knowledge, reasoning, or in many instances, mystical insight. Those who trade by astrology assume some form of mystical insight. The same is true of Gann traders. Funny thing is they're all poor. But as I said, as the clock rolls through midnight and into the new year, we're awash of predictions. You can't avoid them. And this is a little snip I took from the Fin Review, and it says S&P 500 may rise 19% in 2025, say forecasters that got 2024 wrong. This in many ways sums up the tone and theme of this little chat. You need to accept the fact that financial forecasters are, by and large, wrong. So basing your financial future, placing money on statements made by forecasters about some future event, is stupid, because these people are simply making a guess based upon the illusion of knowledge. There is this illusion that if you collect enough facts about something, particularly a very complex system, that you in some way have insight into the complex system and to a degree have some mechanism of prediction and control over the complex system. None of that is true. But whilst we're talking about the notion of how wrong people were in 2024, it is actually worth looking at how wrong they were. These are a series of forecasts that were made for the S&P 500 at the beginning of 2024. It is worth noting that the S&P 500 closed at 5,881 points. So in this little table, I put in the company that made the forecast, what their forecast was, and their error, how much they missed it by. And you can see the error rate is large, and in some cases ridiculous. These are merely little more than guesses, and that's all they are. These are people guessing a number. You might as well throw a dart at a dartboard. But once you get an understanding of it, it is little wonder why in competitions that were run in the past between apes and Wall Street's finest, the apes picking stocks randomly did better. You might raise the point that it is a little bit unfair to judge people and their forecasting ability on a single year. And that is actually true. However, we do have multiple decades of data as to the effectiveness of people's forecasting. This table here tracks data from the period of 1956 to 1995. So it's a very large data set. What it looks at is the notion of a cash to asset ratio. How this works is that when traders, forecasters, analysts are bullish, they move out of cash and into equities. When they're bearish, they do the reverse. So this little table tracks that movement, and it looks at whether the predicted movement for the next year was correct. What I've done is I've marked the occasions upon which the shift in the cash to asset ratio matched what happened in the market subsequent to that move. You can see the number of times they got it right. I would say this is simply a guess, and you got the guess right. This is not in any way indicative of any skill whatsoever. The evidence overwhelmingly is that Wall Street, and by extension any financial market and its individuals within it, are extraordinarily poor at making predictions. Their forecasting records are abysmal. You always need to keep this in the back of your mind when you are consulting any form of financial media. I'll look at the reasons why people want forecasting to be a science and for it to be true and why we cling to it in a moment. But you always need to keep in the back of your mind the notion of, how do I make my trading easier? How do I make my investing easier? How do I remove sources of friction? One of the easiest ways to remove sources of friction, and sources of friction cost money, is to not listen to other people who make these stupid statements. I understand it is very difficult when you are new to markets to do that. You think that somebody must know. Everybody has made that mistake. The truth is nobody knows what will happen tomorrow, and you need to be aware of that and act accordingly, which is why in trading we play defense. We do not play offense. This does raise the question as to why markets are so difficult to predict. You would think that with all the brain and computing power that is available to financial markets and the people associated with them, that they would be able to get this right. Part of the answer is markets are extraordinarily complex and to a degree chaotic. Once you have a chaotic system, they are extremely difficult to model and predict. But whilst I was thinking about this, I came up with what to me is a series of reasons based upon my observations as to why markets are difficult to predict. The first is simple, the notion that humans are irrational decision makers. We're influenced by emotions such as fear and greed, and this leads us away from rationality. So we do stupid things. It is very difficult to model stupidity. You can assume that stupidity exists, we see it every day, but to model it is almost impossible. Irrationality is the cornerstone of the majority of market participants. One of the great failings of modern economics is an inability to understand this. There are still many stalwarts who cling to the notion of the efficient market hypothesis, and particularly the cornerstone belief that humans act as rational decision-making entities within that framework. We don't. The second that occurs to me is this notion of herd behaviour. People follow trends. Trends amplify price movements, and in turn they can actually amplify volatility. This is not so much of a problem for us as trend followers because we want this herd behaviour. We want prices to trend, that is, we want them to autocorrelate. So we shouldn't be concerned about this, but what it does is it makes the forecaster's job extraordinarily difficult. As I mentioned, markets are immensely complex, and the inputs into them, I won't say are infinite, but they are many and they are varied. And the notion of being able to model all these many and varied inputs is to a degree an exercise in hubris. It's simply at present too hard for us to do. There is also the notion of information asymmetry. Despite the fact that markets now transmit information very, very quickly, there will always be an asymmetry in information. Australia, particularly our small mining stocks, is the home of insider trading and pump and dump schemes. It's very difficult to model that in any way, shape or form, but more importantly, there is an asymmetry in the way people respond to information. You can give two people exactly the same piece of information, and based upon their socialisation and perceptual filters, they will respond to it differently. Once you have this asymmetry, it introduces an imbalance. So again, the market becomes more unstable and more difficult to model. There is also this notion of geopolitical shocks, things that come out of the blue, that you could not in any way, shape or form predict. These events have been occurring since we've had markets, and they will continue to occur. And there is no way to predict these events or what impact they will actually have. But perhaps more importantly, from my perspective, is the notion of randomness. It is often said that because markets are random, they can't be traded, and therefore you can't beat the market because it is efficient. Well, that's true except for all of those of us who do. Randomness is not a problem. Noise, to a degree, is a problem, but our trading systems look for the signal within noise, and if there is no signal within the noise, we actually step out. Well, that's what you should do. Unfortunately, traders are attracted to noise, and that is problematic. They're drawn to it, which is why people are drawn to the notion of intraday trading. They're drawn to noise because they think hidden within the noise is a signal they can interpret. Generally not. Generally, all they're running into is a chaotic distribution of price. But this does lead us to the notion of why traders make predictions. Why do people involved in markets make predictions? To some degree, from my perspective, having observed it over the decades, it is this notion of an illusion of knowledge. Once you have an illusion of knowledge, you have your ego invested in anything you say. So therefore, you are going to want to make these sort of pronouncements. And the market thrives on these sorts of pronouncements. There would be no financial media if there weren't talking heads getting up, making nonsense statements about pick a market, pick a stock, pick a commodity. But there are underlying reasons as to why we make these predictions. And I once again need to make the distinction between what traders do and what forecasters do. Some traders do make predictions, and it is much to their folly. But sensible traders make bets. And as I said, bets have the element of doubt and uncertainty to them, which is why it is a bet. The human brain is a prediction engine. It's constantly making predictions. It evolved to perceive and control the environment, and consciousness further enhanced this ability within us. So by modelling the environment and the self, we can make adaptations to the future. We try and be malleable to what is happening, but unless we make some sort of statement about the future, we don't know how to respond. We don't have a set of behaviours already encoded within us that we can bring to bear. Prediction is a function of being human. We do it every day, but we need to understand the limitations of where prediction ends and where guessing begins. The other notion that struck me was this notion of anticipatory cognition. we're wired to anticipate the future. It is why we are successful as a species. We understand that there is a future and that we can actually plan for it. Traditionally, psychology, from my perception of it, had looked at this notion of past cognition, the notion of memory, and present cognition, which is perception, what is happening now, what are we perceiving now. We now do have some movement towards this notion of why do we anticipate events and how do we undertake that task, and what occurs when we undertake that task and why it is important to us. The problem is it drags us back to this notion of prediction, and it feeds into the notion that our brain is a prediction engine. It desperately wants to make predictions. We see patterns, and from those patterns we attempt to draw some form of conclusion. Unfortunately, we have this notion of faulty expectations. Our expectations influence our perception. And when our perceptions don't align with reality, all sorts of interesting behavioural things occur. In effect, traders to some degree are subject to very weird illusions. When their prediction does not align with reality, let's say you've made a prediction about where price will be in a given time, and it does not get there. That's a faulty expectation. When that occurs, our brain does some interesting things to us. It begins to attempt to rewrite reality, and it backfills and changes what our prediction was. So instead of our prediction being a concrete thing, to preserve our ego, we attempt to rewrite what we actually thought. So we rewrite our own narrative. Finally, there is this notion that I came across known as the Barnum effect. It is this notion which I touched on before, that we find some sort of meaning in predictions or assessments about the future, but this often leads us to overly positive predictions. Traders have this habit of being overly optimistic about anything they buy, anything they do, but it's not confined to traders, it is a generalised human statement. And so we have this notion of embedding ourselves within our decisions, and we become defensive of that, particularly when the decision starts to go against us. And again, this flows back into the notion of how you deal with things like stop losses. A stop loss exists within the market to prevent you from blowing yourself up. The giveaway is in the name, stop loss. But so many traders allow price to blast through their stop loss because they do not want their ego to be threatened. Humans act in an ego-defensive manner. We want to defend our ego. If my stop loss is hit and my psychology is not aligned to what it should be as a trader, then I'll ignore it because I can't admit I was wrong. This brings me back to a fairly simple summary. We want to believe, the general population want to believe that we can predict the future, that we know the future. It's intriguing. Yesterday I went in to have my yearly eye check, and next door to where the optometrist is an Indian psychic reader. I was so tempted to go in and ask whether they were expecting me. But we want to believe. People want to believe the future can be predicted, because future that cannot be predicted is quite scary. It is destabilising. It would be wonderful if we knew exactly what every given instrument we were going to trade was going to do over whatever time frame that we were trading. But that's displaying a lack of reality. That's not how the market works. The market is chaotic, it is noisy, it is dirty. There is asymmetry in the transmission of information, there are shocks. There is our psychology trying to deal with all of these things, but also our own coding, the way we see the world. So you have this very, very dirty mixture of things conspiring against us being able to make predictions, but also to resist the notion of other people's predictions. So where does this leave us? It leaves us with the notion that trading systems are king. because they simply remove the notion of prediction and they remove the notion of relying upon other people's predictions. But the point I will end on, and this is one for posterity, which we can come back and have a look at next year. These are Wall Street's expectations for 2025. So what I would suggest you do is pause this here, snip this out, and next year we can come back and review it for shits and giggles.